Assalamualikum OyaRahmatullahe OyaBarakatuhu. Innal hamdanillah wassalatu wassalamu ala rasulillah. Amma ba'd. Bismillahirrahmanirrahim. This is Muhammad Kamrul Hassan, Department of Business Administration, Metropolitan University, Sylhet. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Today we will try to discuss comparative financial statement analysis or horizontal analysis. So today's topic, comparative financial statement analysis. So here you remember that comparative, so that means you have to compare. This compare basically in your firm year to year compare, and this is very essential for a company to prepare a good financing or investing decisions, where you can know the financial performance of a company. So basically we generally compare one company to another company. That's also the comparative analysis. So here comparative financial statement analysis, that is income statement analysis, balance sheet analysis, cash flow analysis. So you can compare these tools for your company to know the performance. Individuals conduct comparative financial statement analysis by reviewing constructive balance sheet. Income statements were a statement of cash flows from period to period. This is usually involves a review of changes in individual account balances on a year to year or multiple year basis. So year to year change or multiple year basis changes. The most important information often revealed from comparative financial statement analysis is trend. Trend means year to year what will happen. Trend as like this is the trend. It is the trend, upward trend, or whenever it is downward trend. So this is year 2002, 2020, over 2021, 2022, etc. This can be happened by this comparative financial statement. So you can see what will happen future. This is the increasing trend, this is a decreasing trend. So you can use this in this comparative financial statement analysis. A comparison of statements over several periods can reveal the direction, speed, extent of trend. Comparative analysis also compares trends in related items. For example, a year to year 10% sales increases accompanied by a 20% increase in freight out cost required investigations and explanation. Similarly, a 15% increase in accounts receivable along with a sales increase of only 5% calls for investigation. Comparative financial statement analysis also is referred to as horizontal analysis, given that left right or right left analysis of account balances as we review comparative statements. Two techniques basically used for this comparative financial statement analysis. One is year to year change analysis and another is index number trend analysis. Now we will see year to year change analysis. Comparing financial statements over relatively short time period, 2 or 3 years, is usually performed with analysis of year to year change in individual accounts. A year to year change analysis for a short time period is manageable and understandable. It has the advantage of presenting changes in absolute dollar amounts. So here has the important things: absolute dollar amounts or absolute taka. So year to year change also show you absolute dollar, and as well as it shows you to the percentage. So here is a very good thing. So you can see the results in two ways. One is absolute dollar and another is percentage. Change analysis is both amounts and percentage are relative, since different dollars basis is computing percentage change can be a large change inconsistent with their actual importance. For an example, 50% change from a base amount, one is 1000 taka, another is 1 lakh taka. So these two amount cannot be changed. So here I said 50% change from the base amount, 50% change. So actually this 50% here says the 50% equal to 1000, and here says 50% equal to 1 lakh. So that's why absolute dollar amount is very much important for comparison, and it is shows by year to year analysis or comparative analysis or horizontal analysis. So these two are 50%, but absolute dollar is different. That's why it is important. Reference to dollar amount is necessary to return a proper perspective and to make valid inferences on relative importance of changes. Computation of year-to-year changes is straightforward. Still, a few rules should be noted. When a negative amount appears in the base and positive amount in the next period, and vice versa, so we cannot compute meaningful percentage change. So whenever there has the negative amount, actually that is not the meaningful amount, so meaningful percentage. And also when there is no amount for the base period, whenever there is no amount in the base period, then no percentage change is computable. Similarly, when the base period amount is small, a percentage change can be computed, but the number must be interpreted with cautions. So there is the rules of computing year-to-year change over comparative analysis. So whenever a negative amount appears, then actually that are not the meaningful percentage change. Whenever the base amount is 0 or base amount is 0 but base period amount is 0, then the percentage cannot be computed. Again, whenever base period amount is small, then you have to interpret the result is very cautious, very carefully. This is because it can signal a large change merely because of a small base amount. There is a signal of large change with a that's where has a small base amount used in computing the change. Also, when an item has a value in the base period and none the next period decreases is 100%. So that's why you have to interpret this type of amount very carefully. So here as an example, we will see 2011 and 2010. Net sales, cost of sales, gross profit, selling, general and administrative expenses, others expenses, operating profit, interest expenses, income before income taxes, provisions for income taxes, net income including non-controlling interest, etc., etc. There is the several items. That's the income statement, you see. So now we have to prepare a comparative statement. So we are given this data 2010 and 2010 and 2011. We have these two types of data. Now we have to prepare a comparative financial statement for the 2011. So there has a rules. You can easily find this value 2011 and 2010. If you subtract this value, that is 1170. 2734 minus 15,564 equal to 1170. So that is very easy for you to calculate. In the cost of sales, 7,144 minus 6,360 equal to 784. Now it is time to calculate percentage. So you have to remember that there is a rules, that is new minus old divided by old. New minus old divided by old into 100. Can I make you understand? New minus old divided by old into 100. As like new, that is the new 2011, 16,734 minus 15,564 divided by 15,564 into 100. Clear? Then you can get 7.5%. So you can calculate this value in this way. All the percentage you can calculate in this way. Similarly, cost of sales 7,144 minus 6,360 divided by 6,360 into 100. You can get the 12.3%. In this way all of you can calculate. And in here other expenses shows the negative amount, negative percentage, so it is very difficult to interpret this type of results. So that is the rules. Now there is a time for explanation. Your result. Net sales, you see change 7.5%, that is the positive change. Now you can say net sales increases by 7.5% compared to the past year. Can I make you understand? Net sales increases 7.5% compared to the past year in this year. That means whenever we compare this performance of this company 2010 to 2011, here we see that in 2011 this company increases its net sales by 7.5%. Cost of goods sold increases 12.3%. In the same way, net income increases 10.3%. So in this way you can explain all the result, what will happen. That is the year-to-year comparative financial statement analysis, or you can call it the horizontal analysis. Why? Because that is the analysis to left to right or right to left. So here we are seeing left to right comparison. That's why that is the horizontal analysis. After that we will see index number trend analysis. Using year-to-year change analysis to compare financial statements that cover more than 2 or 3 periods is sometimes cumbersome. A useful tool for long-term trend comparison is index number trend analysis. Analyzing data using index number trend analysis requires choosing a base period for all items with a pre-selected index number, usually set to 100%, because the base period is a frame of references for all comparisons. So index number, also the another types of analysis. Here you have to take a base period for your comparisons. In the previous examples, if there has the 2012 periods data, and you can take the 2010 as a base period. Then that is the old data, and that is the new data. That is the new data, that is the old data. If there has the 2013, in the same way, that is the new data, that is the old data. That means you are comparing to the 2010 according to this period. If there has the 2014, that is the base period. Then you can call the net sales increases as a specific this percent according to this year 2010. That's the index number trend analysis. So here as an example, you can see Syntec cash balance at December 31 year 1, the base period 12,000. Its cash balance at the December year 2 18,000, using 100 as the index number for the year 1. In the index number year 2 equal to 150 as a computed result. So current year balance is 18,000, and base year balance 12,000 into 100, that is 150. That means year 2 the cash balances is 150. In the same way, the year 3 the cash balance is 9,000. Then the index number says that is the 75%, according to the comparison of base year, because base year is 12%. So you can calculate these percentage in this way, index number. The change in cash balance between year 1 and 2 for the illustration is 50%, and is easily inferred from the index number. However, the change from year 2 to 3 is 75%. So as a direct comparison might suggest, instead it is 50% computed by in this way. So this involves computing the 2 or 3 year change by reference to year 2 balances. The percentage change is however computable using index numbers only. For example, is computing a change, we take 75 divided by 150 is 0.50, that is change 50%. So here you will see the year 2 to 3 can be changed by 50%. So here this is the index number, where basically takes a base year balance and the current year balance into 100, current year balance into 100. So that is actually the index number. Now in normal year, with regard to the business conditions, as with computing year to year percentage changes, certain changes like those from negative amounts to positive amounts cannot be expressed by means of index number. So index number, we are not using these types of matter, year to year percentage change, certain change, negative amounts or positive amounts cannot be expressed by this means of index number. So index number in the year you can calculate in this way: current year balance divided by base year balance into 100. This all about today. Stay home, stay safe, try to maintain a safe social distance, try to wash your hands frequently in a day. Subhanaka Allahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaika. Assalamualaikum warahmatullahi wabarakatuh.